Hello my fellow freedom builders and welcome back to the channel. Now in today's video I have made a thumbnail and a title that I know is a bit provoking and it may be a bit of a clickbait, but what I'm saying here is, can we be better than Warren Buffett? And the reason I'm doing this is actually triggered by the video I made yesterday about Warren Buffett going into gold stocks, and I found it funny to see if some of his top holdings, if we could have gotten into them or out of them at the right time. So when I'm talking about beating Buffett, I'm not really talking about beating them because they're beating him, because there are a lot of buts to be put in here. Because I can hear you saying, yes, but Warren Buffett has proven himself over the years and he is way better than you are, Hans. Yeah, well, he might be. We are applying two very different approaches. Warren Buffett is a value investor. He is finding some stocks that are undervalued, where the price is good, and he's waiting for the long run for years and years and years for this value to come through in the price. Where I am looking a bit at the fundamentals and then a lot of the technicals. In the video today, I'll show you or repeat to you, if you have seen it already, exactly how I do it and how I would have entered in the top 12 holdings of Warren Buffett in his Berkshire Hathaway right now. And we can kind of get an idea as to if I could have done better than him. But there are other buts. He has more money to move around. And yes, this might be the biggest thing, because Warren Buffett has billions and billions and billions of dollars to move around. And for instance, he has his biggest holding, which is Apple right now. That is 45% of his entire portfolio. And if he were to sell all of that right now, it would be something like 90 or 100 billion dollars of Apple stocks he would sell right into the market, and of course that is not possible. So yes, this is more of a thought experiment, and if you're thinking I could never do as good as Warren Buffett, then I hope that today I might give you an idea that with some quite simple tools you can at least do somewhat as good as him. Then there will be some of you saying, yes, but he has lost it over the years. Well, that's a hard one to say, because he has been in the game so many years. And I know that his best years was in his younger years, because he had a lot less capital that he should move in and out of different stocks. And of course there is that. But then again, there were also people back around the dot-com crash around 2000, 2001 that said, yeah, well, he lost it because he hasn't entered tech stocks. And well, the tech stocks went down, many of them 90%, and it seemed like Warren Buffett actually hadn't lost it at all. They were also saying that up to the crash in 08 and said, yeah, well, Buffett is getting old, he has lost it. But it seems after the 08 crisis that actually he hadn't. So now, well, I don't know if he has lost it, but I'll let time decide on that. Then there's another thing, and that is that he's going a lot for the dividends and he's reinvesting the dividends and so on. And I'm not really calculating the dividends in here, so there's also that. So that there actually are some valid buts here. Now, how should we measure this performance if we were to do it? Of course, we could just look at profit in percentages, but as you know, or as I hope you know, if you watch my channel here on a regular basis, then just measuring at a certain percentage is not really good enough. Because if I'm making 100% per year, but 5 times a year, I'm risking every single cent, and I'm a few cents in the stock market from going completely bankrupt, then 100% per year is not very desirable. But if I can make 30% per year with a very small risk, well, then there's a lot more quality in that. And what I'm gonna show you today is that I can actually do somewhat as well as Warren Buffett, but with a lot less risk. And that, of course, comes into this sharp ratio on max drawdown, where we are seeing how much fluctuations are there in our portfolios. Because Warren Buffett, he is a buy and holder for most of the time at least, meaning that when the market crashes, he's easily taking 40 or 50 or 60% on the downside. I just made a run through of my portfolios today for my Danish subscribers on our subscriber area, And in 2 of the 3 markets in Scandinavia, my strategy has beaten the market by quite a lot this year. And then the Danish market, we're a bit behind. But in all 3 markets, my strategy has only been down at the worst time somewhere between 9 and 12% in drawdown, whereas the market has been down 35%. So we have to look at how much risk are we taking and how much time are we actually in the market. If I can make 20% a year only being in the market 1 month, then I am without a risk for the rest 11 months. So that is also it. I'll get through to the stocks just in a second, but just remember what I'm doing here is not trying to be some sort of smart ass. I'm not trying to say that I'm more clever than Warren Buffett or that I know more about the stocks than Warren Buffett. What I actually do is I am, and I've used this picture before, I imagine myself as this tiny flea that of course should have been this small. I'm imagining myself as this flea, being on the back of this elephant. And I'm trying to choose the elephant that is going at a good speed in the right direction. So I'm picking the stocks that where I can see the big guys are moving into. And when I can see that a stock is moving in the right way so that I can see the big players are in it, then I'm riding that elephant as that little flea on the back of an elephant. And when that elephant starts to move in the wrong direction or slow down in speed, then I try to jump on to another elephant that is going a bit faster. That's pretty much what I'm doing. I have mentioned this several times in my video about investing without ego and so on. So this has nothing to do with being clever. This has all to do about being able to follow a trend. So let's have a look at the 12 stocks. And I have picked this 12 stocks from the Guru Focus website here. That is a website I'm subscribing to. And it is, of course, called Guru Focus because you can see a lot of the gurus in there. For instance, Warren Buffett, but all of them actually. And you can see what are in their portfolio right now, or at least 45 days ago, because this is the quarterly announcement he's making, so we don't know actually what he's bought and sold for the last 45 days. So what I'm trying to get a look at here is, could we have done better, or at least almost as good as Warren Buffett with the 12 best stocks here? So I actually had planned a top 10, but they were mostly, or there were a lot of banking stocks in here, so I picked a couple of more here at the end that was not in the banking sector. So let's have a look at it. First of all, here is the Berkshire Hathaway stock or investment that you could make. I know that some would say, yeah, well, Warren Buffett, let's see how he has been doing. In 2020, this year, he is down something like 7%. That is not too amazing, and the market is up around the all-time high again. And yes, Warren Buffett is not claiming that he's doing better than the market all the time. What we can see here is, if we are looking at some other years, we have the 2019, he did something like 15%. The market was up, 25, 27. So again, a year where, well, compared to the market, he might have been able to do a bit better. Then we had 2018 here. And if we look at that, I think he went just about break even, maybe with 0.5% in minus. But the overall market was actually down something like 5 or 6%. So here he actually beat the market. And if we are looking back here over time, I think that most private investors would be a bit envious of a portfolio like this. It is quite consistent. But what you should also look for is that the drawdowns are often quite long. For instance, here in 98, he had a drawdown of 50%. And from the drawdown started in July 98, up until he was back in break even, it took him 6 years. You can see the same here in November 07. The portfolio went down 52, 53%. And that was from December 07. And when he was back in break even, that was something like 4 years later. So he is often taking these huge bumps down. Here we have an 18%. Here in the last drawdown here this year, he's down 30%. And that is, as I mentioned, something we should consider when thinking if we can beat Warren Buffett. Because we could, or we might actually be able to make just a bit less of a performance than him, but do it with a lot less risk, a lot less volatility and drawdown. And that would actually make us doing better than him in what is called a risk-adjusted return. So let's take a look at the stocks. I know that you are eager to see these stocks. So let's have a look at Apple. And I'm not looking far back and I'm not calculating percentages, but what I am doing here is trying to give you a picture of what we are able to do with the simple trend following strategy that I normally mention. If you've seen my videos before, you know that I'm looking at two things. I'm looking at the RSI here. That is a 14 weeks RSI measuring the stock's strength towards itself over the last 14 weeks. We want that to be above 50 because that shows us we're in an uptrend. In the lower indicator here, that is our CRS, showing with the gray line, if that is below the two other lines, shows us that this stock is doing better than the overall market. Now, what I'm doing when I'm investing is that I'm calling this a green zone stock when both of these criteria are met. The RSI a bit above 50 and this one above the two SMAs here. Now, what I am doing is that when this goes into green zone like here, I am looking at my daily chart, and then I'm looking at the price versus the 20 SMA. That is the black line here, the moving average for the last 20 days. And I'm looking for a break up through that, a little retracement and some strength, and then I'm entering. So what we can see here with the Apple stock is that, of course, this is one of the cash cows of Warren Buffett's portfolio. And the fact that he's in Apple here with 44% of his portfolio, and it is up 400% over the last 3 years. Well, that is very amazing. What we can see here with our simple strategy is that we could, without knowing anything about Apple, maybe just reading that Warren Buffett had it in his portfolio, but without knowing anything about the fundamentals, actually, if we didn't know Apple, we might not even know what they were selling. It could be that they were actually selling apples and bananas and tomatoes. Who knew? But just picking it from this simple strategy, we could have entered down here around 205. We would have been kicked out here because of our entry and exit strategies here. So we would have been kicked out here around 280, would have gotten in again here around 290 and been riding it all the way up. That is how simple it is. And I know that Apple is an easy stock because it has been trending so much. So let's have a look at some of the others to see, just here in Apple, buying and holding. Warren Buffett might actually have done a better job than me in my strategy here, because that he's just buying and holding, and this one is just going to the moon pretty much. It has been almost a no-brainer to hold on to. But again, already here we can see that I am not taking the large drawdown. That means I might be missing a bit. As you can see here, I might be going out in 280 and maybe in again in 290 or 95. I don't really care about that. That is the price I'm paying to avoid these huge drawdowns. Now on to the next. And here we have, let's see, Bank of America. Now looking at this one, it is one of the big holdings here. And Warren Buffett has been holding this for years. Now that means, of course, that he took the very nice upturn here. We would have gotten in somewhere around the 17 mark here. And we might have gotten out here. But what is also important here is to say that if we had gotten out here in June 18, we would not have gotten in before October 19, meaning that we would have 15 months where our money could do something else, instead of just sitting idle here in an investment going sideways. Then we could have gotten in here with our specific rules around 31, and we might have taken a little loss on it because the stocks dropped here. So we might have gone out, I don't know, 27, 28, 29, somewhere around here. But in all this time, back from February 18, we were only in here and taking almost a break even, maybe with a little loss. But all of this time in these 2 years, our money could have been sitting in something else. And that is a very important lesson that people often forget when they're looking at a stock and say, yeah, well, over the last 10 years, it has gone up 200%. Well, if 5 of the years was the stock going sideways, then your money could have been in a stock that outperformed the market in the same time. On to the next. We have the Coca Cola here, and that is, as far as I remember, one of the longest time holdings of Warren Buffett. He has owned this forever. He was out of it at some point, and then he was in again, and he is in on it partially due to the dividend, of course. But if we are looking at the last couple of years, then from here around January 18 and now 2.5 years later, this stock was just have been a break even. Then of course comes some dividends. We have to calculate these. But in this time, the only time I would have been in the Coca Cola stock here was from around 49 here, and then I might have been kicked out somewhere here 7% later, so I would have made 7%, and all of the rest of the time in these 2 to 3 years I would have been able to have my money in other stocks. So I hope you start to see the picture into my philosophy here, saying that I don't need to own a stock forever. If I can go into the stocks where I can see the big players are running into, and I can be in on the part of the run where the stock is actually moving fast, and when it starts to lose speed, well, then I can get out, and I might get in on a later date. I never regret getting out of a stock because I get my sell signal, then it turns around and I might get in again. But that is just the price. That is simply the entry price, the ticket price, to get the good long runs and to avoid these huge losses. Because I might not have made the exact same amount that Warren Buffett did here, but I also avoided a drop in the price of 40% on Coca Cola stock here, and with all the anguish and lost sleep that would have followed there. All right, American Express, pretty much the same picture here, as you can see. I'm not going far back here because I actually got some very good buy signals there down here around 68. And as you remember, when I'm talking about trend following, a trend follower never gets in at the bottom and never gets out at the top. And that is a tough psychological thing to swallow, but that's just how it is. It turned here around 50, and then I would have gotten in, let's say, at 70, and that's 40% up from the bottom. And you might think, well, that is a lot. Why should I get in and missing these 40%? Well, because you're getting all the rest. And here we would have gotten in again at around 105. We would have gotten in or out at 122, so that was a nice gain. We wouldn't have been in on this one, but we would also have avoided the huge drop here at 50% in American Express. So, and still, by now, it is at the same price as if you had bought it in January 18, and you would have just held it for, what, 3.5 years? Yeah, 2.5 years maybe here. So this is what to look out for. Now, on to the next one. And that is Kraft Heinz. And that is, of course, one of the really bad examples of buying something you think is value. Because Warren Buffett went into this investment up here. And I made an entire video about the Kraft Heinz thing. But what we can see here is a very good example that, yes, there are some stocks where we get in and out and maybe get a bit more of a trading cost because we get in 1 or more 2 times more than Warren Buffett. But then again, up here from the beginning in June 17 and then down till now, the stock is still down something like almost 60%, and we would not have been in at all until here where we get our entry and have been able to be in somewhere around 30 and now up to 35. So at this very long time span where the Kraft Heinz investors and Warren Buffett would have been in and have been sitting with money in this stock doing absolutely nothing, we could have invested in a ton of other stocks and then entered here and made 10 or 15%. So that is pretty much the essence of it all. We have Moody's Corp, and this is, you could say this is a good example as to the bad thing with my strategy, because this is not all good, not at all. Now with Moody's, Warren Buffett could have bought here. I have no idea where he got in, but let's just say he got in here around, let's say 150, because he thought it was good value, and he could have taken almost 100%. Now I haven't calculated the exact percentage here, but I would have gone in here and out, in again and out, in and out, in here. So I would have made a profit, but it might have been 20% or 30%, and Warren Buffett would have made 100%. So it's not that my strategy is beating Warren Buffett all the time, but it is a strategy where you don't have to be Warren Buffett. You don't have to have a team of analysts. You can pretty much just look at a chart, simple strategy, and then go in and out when the strategy dictates it. We have Wells Fargo here. He has been selling out of that lately, but you can see here from September 18 up here, and before that it actually went sideways for quite a while, and yeah, you could pretty much not have made money on this since the last 5 years or so. Our strategy would have sent us in down here, out here, and kept us out for a long time here. But the last couple of years, you can see we got a sell signal here, then a little buy signal at the end of 19 where we could have gotten in around 50, maybe out with a slight loss here of a couple of percent, but we would have avoided the entire downturn here with a loss of 60% at the worst time. So I hope you can see why I sleep well at night. We have the same picture here with US Bancorp, also one of his holding. We have Davita, which is one of the last one on the list down here, healthcare providers and services down here. And you can see we got out here. Then we got in a bit later. We missed a small percentages here, meaning that we would have lost maybe 5 or 10% of the upturn. But we were not in the stock all of this time. We got in here, out here with a small profit, and then we wouldn't have been in after that. We have the Bank of New York Mellon here. We got our sell signal here, and we would not have been in ever since. So you can see that is a loss up until now since our last sell signal at 27%, and we avoided the 48% drawdown in the portfolio here. And if we have, let's say, 10% in one of these stocks, this would have been an almost 5% drawdown on the entire portfolio just by owning this single stock here. Then we have the Charter Communication. This again is one of these stocks where, of course, if you had just bought and held it, you would have been up 146%. That would have been great. Of course, you would also have taken this big drawdown here. On our timing strategy, we would have gone in around 350, out with, I don't know, 7-8%. We got in here around 411 again. Go out around 488, we would have gotten in here at around 550 and would still be in it. So we have a lot of smaller trades with smaller profits, and sometimes we lose some of the upside. But as you can see again, we avoid the entire downturn here. I think this is the last one, the very sign here. Again, a stock, I could have gone back. That is easy when you have trending stocks, because I got buy signals here and here and here. So we would have been in on most of the upturn. But now I'm just looking over the last couple of years here. And as you can see, our very rule-based strategy got us in here around 162, out around 200. In again here and out with a small loss of maybe 10%, something like this. Had you just been sitting the last couple of years, or at least the last year here with the money in the stock, it would have been a break even. So this is my strategy, and I have mentioned it in a lot of videos now. We have the RSI, we have the comparative relative strength, and then I'm looking at the daily chart where I also like the RSI to be above 50, and I like to see some bounces onto the 20 SMA. There are some of these stocks today I have shown you that I have absolutely no idea what they are doing. Of course, the banks I have some idea, but there are some of these that I don't know. I don't know their fundamentals, I don't know anything. And when I normally invest, I don't just use this. I also have my Q score. My subscribers know that one. That is where we are taking one combined score to get an idea of the quality of the earnings and the growth in the earnings and so on. And I'm using that Q score to make sure that it is good, solid, fundamental companies. And then I'm looking at the technicals. So, the video was, could you beat Warren Buffett? And it is not as simple as this. I like this strategy a lot more than I would like Warren Buffett's strategy, because simply that I don't have to be in a stock for 5 or 10 or 25 years to make sure I get the full effect. I can be in for a few months or maybe a year or something like that. I don't have to guess where the stock will go. I never guess. I have no idea when I enter a stock if it'll go up, down or sideways, but I know exactly that if it goes up, how should I react? If it goes sideways, how should I react? If it goes down, when should I exit? So the second I pull the trigger and buy a stock, I have a complete set of plans as to what to do in all the different scenarios. And when I have people asking me, oh, I'm in this stock, it is down 8%, do you think I should buy more or exit? Or, well, first of all, I'm not a financial advisor. And secondly, it tells me that this person doesn't have a fixed plan. They don't have a fixed set of rules that they can invest from. And that is the important thing. You don't need to copy my trading rules, but you need to have trading rules. That's all for now. I hope this was a bit of an inspiration to you. Remember to subscribe to the channel and hit the like down there and the bell notification if you want to be notified when I come out with my next video. Take care of yourself and your money out there, and I'll talk to you again soon. Bye for now.